Hello everyone and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it's been, again, another relatively quiet day in terms of economic data. There has been a couple of important releases, just not many in terms, not a big day in terms of the number of economic releases, but that's absolutely fine. I do think there is a bit more of a focus right now on corporate earnings season. A lot of the stories that we're seeing in the financial press at the moment do tend to relate more to corporate earnings more so than they do to things like economic data and other news flow. But it is worth noting, as I've warned in all the previous videos, that these earnings results, sorry, they do have a big impact on sentiment in the markets, and it's that sentiment which can flow through to other markets and guide them. So it's always worth keeping one eye on what's happening from a broader perspective. You don't have to obviously read into the individual results themselves, but as you can see, there's two important pieces of data here. There's the GDP figures for the UK, and then most importantly, the durable goods orders for the US. Now, durable goods orders were in line with expectations, and the previous number was actually revised higher. So there wasn't an enormous reaction to that. Pending home sales were a little bit better, and jobless claims were broadly in line with expectations. Now I think it's the GDP figures which I think are having the biggest impact, because we are seeing, as you can see, the pound actually trading lower today off the back of them. We did get a bit of a spike initially from the reading, because at the end of the day it was a big surprise to the markets. We did see 0.5% growth in the third quarter, which is higher than we were expecting. We were expecting around 0.3%. The report did say one thing which was particularly of interest, and that's that they don't think the Brexit result has had any impact yet on the data. Now, I would beg to differ in one specific area. Now, I'm not one to argue with the ONS. I'm sure they're far more educated on the subject than I, but while we're not seeing the negative implications of Brexit, we are seeing some of the positives. It did talk about the uptick in tourism and the improvement in exports, and this has been driven, as it even stipulates itself, by the weaker pound. The pound obviously has fallen by around 20% against the US dollar and close to that against the euro. So we are seeing some of the benefits of the Brexit vote, but we're not yet seeing the downside, which I'm sure will come in the coming quarters. People did expect it to come quicker. In reality, it tends to take a little bit longer than that. The inflationary impacts is going to be the biggest of these in the coming quarters. The reason being that with a depreciated currency comes higher input costs. Higher input costs have to be absorbed by someone. Companies, of course, they are not charitable in that way, so they are going to obviously pass on some of the cost to the consumer. They may absorb a little bit of the cost themselves and have it squeeze their margins, but that's only going to encourage them to squeeze staff as well. So that means hiring less. It means keeping wage growth subdued as well, and that inevitably has an impact on the consumer, because you're not seeing wage growth at a time when prices are still rising. That is when we're going to start to see the biggest impact on a consumer economy like the UK, but that does take time to filter through. Now we are seeing, it looks as though the pound has shrugged off much of the actual data today. Like I say, we did see a little initial spike, but we are clearly now trading lower, and that 120.90 to 121.30 now is back in view. If we see a break below there, then that could mean a move back towards 120 in the short to medium term. I think it's going to take something substantial to prompt a move through 120 at this stage. You'll notice I've already moved straight onto the charts, and that's because, to be honest, with lack of news flow in the markets and the fact that the actual charts themselves are actually starting to get quite interesting once again, I think it just makes more sense to move on to the charts. There is one other thing I did want to highlight, and that's the CME Group Fed Watch Tool. This is the tool which gives you the implied probability based on the Fed funds futures rates in the market of a rate hike in the coming meetings. Now, you may or may not know that with the Fed meeting on Tuesday and Wednesday, the Federal Reserve policymakers are now in the blackout period. That means they cannot talk to the media, which is why we're not talking about Fed speeches every day like we were last week. What is interesting, though, is while we're only pricing a 9% chance currently of a rate hike in November, which is next week, December is right up there. It's now close to 80%. The markets are really believing in this rate hike story at this stage, and I think it's going to take something quite significant for markets to forget it. That is the CME Group Fed Watch Tool. If you put that into Google, or if you copy that link you'll get access to that, and you can see all the upcoming, and it gets updated as well on a daily basis, or sometimes multiple times throughout the day. So it's always worth keeping an eye on to get a real gauge of what the market is actually thinking and doing. So there is a couple of things which I did want to highlight. The first one is one that I've been touching on for a long time, and we finally have seen that break higher. The dollar yen, we saw the break through the cloud initially, and it was really dragging its feet. It was given the idea that it really didn't want to push higher, despite the fact that we'd had this bullish break, a break which has been a year in the making since we actually broke below here late on last year. We can see the clouds on numerous occasions providing resistance for this pair, providing resistance. Then we had this bottoming formation where we couldn't seem to make a lower low to save our lives. And then we saw a bit more pressure on the cloud, and now we've broken above it. And you think, well, what is it that sparked this move higher? Well, if you look back 26 bars, you can see the lagging line. The lagging line is seen as confirmation of any break above the cloud or below it, of course. And now we've seen the lagging line, which in this thick dark line has actually broken through the cloud, and that seems to have provided the stimulus for the move higher. We're now at 105, and for me, this is now looking quite bullish, and I think that 107.50 could not be on the cards in the coming days or weeks. Now, you wonder what is driving this. It seems to be a stronger dollar at this moment in time. As I highlighted with the Fed Watch tool, the markets are pricing in a rate hike now in December quite heavily. The euro yen seems to be trailing this a bit, but we are seeing some pressure to the upside, so I wouldn't be surprised if that dollar strength, which has pushed the yen lower against it, could filter through into weakness in the yen against the euro as well. Now, the euro itself isn't looking particularly strong, so that's why we are seeing it trail the US dollar. But the fact that we've seen that very bullish break in the dollar yen does make me think that we could see this 115 level, which is the top of the Ichimoku cloud, coming under pressure in the coming days or weeks. We've got this descending trend line here as well, where we've seen it tested on a number of occasions, coming under serious pressure once again. For me, I think we could be looking at a bullish break here, and if we do see that, then we've got 116.35 as the next level of resistance, and again, keep an eye on that lagging line for confirmation. Really, we may even be looking at 120 in the euro yen potentially. Obviously, it's still a very early stage, but if we see a break through the cloud, then I think 116.35, then you're looking at around potentially 118.40, and then I think 120 could potentially be relatively realistic. So it's always worth looking at these for signs that one market could potentially be leading another. Now, you'll also notice that we are seeing a break higher in crude. For those of you who missed it on Tuesday, we saw API reported crude inventories, and they reported a 4.8 million barrel build, which obviously led to some weakness in the market. You can see this big red candle here was sparked by that build in crude oil inventories, and we were expecting a similar figure to be reported by EAI yesterday. In fact, not only did we not get a build, we got a 500,000 drawdown, and that is what sparked some strength once again in crude. Drawdowns means it's higher demand and less supply, and that tends to be bullish for oil. Larger builds tends to mean less demand and more supply, which tends to be bearish for crude. Now, it'll be very interesting to see how it holds around this 50-50 level, because for me, this was the neckline of the double top which we had here, which suggested to me we were looking at a move back towards 49. Of course, when fundamentals change, sometimes the markets change as well, and this is now your first level of resistance. That's not to say that if we break above here that the double top is not still in play. It absolutely is. It stops being in play when this level 53 does get broken, and when that gets broken to the upside, that would suggest that the market's fundamentally shifted. This is just the first test around 50-50, so we're looking a little bit bullish in the short term on Brent crude, but I'm still not convinced that we're going to see a substantial move to the upside. The final thing I wanted to touch on here is indices, because indices continue to look weak. We're seeing these moves in crude, we're seeing these earnings, and they are being a key driver, but really they're just moving sideways at this moment in time. We are still seeing this consolidation, but we're still, most importantly, getting this series of lower highs in the markets. And once again today, we've touched this trend line, and then it looks like we've pulled off. This can consolidate for a little while yet, so I wouldn't get too excited at this stage, but this continues to look a little bit worrying for me. That's the US 30 or the Dow, the SPX 500 or the S&P 500. We're getting similar issues as well. We've broken below the moving averages. We've still got that descending trend line above, and for me, this is looking a little bit toppy here. We also brought up the DAX, I think, yesterday, or the DE30, which is the DAX. And again, this is looking a little toppy for me as well, because we're trading around these highs, but we're just not able to push on above. It seems every time we try, we get kicked back once again. If we do come back towards these levels, then that trend line for me becomes quite interesting. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which got a lot of great tools designed to help you with your trading.